financial crisis recovery.
Foreclosure, short sales, bankruptcy, credit card debt, job loss, depreciating home values, money management. Peace of mind when it comes to your finances seems completely out of reach under current conditions, but there is a way to achieve it. For the next 60 minutes, you're going to find out how to cover your assets. Cover your assets.
Yeah. Well, after I started my legal career at the Attorney General's office and then went to a student loan guarantee agency, and this is one of the players in the student loan program, and we'll talk about where they fall into there. But I spent 11 years working for a student loan guarantee agency, and the parent company of that company also owned a collection agency, which was one of the...
what a surprise that is.
You know, it's funny. You see they often have, I think Sallie Mae's another example where you have Sallie Mae servicing the loans, USAF is a guarantor, and then you have collection agencies like Pioneer and GRC who are all owned by them in this big, three-headed monster.
Right.
And so I worked for, I was 11 years in the student loan industry, working for the guarantee agency and also working for a collection agency which collected for the Department of Education. So I've been on that side. I understand the programs. I've worked with, for example, the rehabilitation program, which is a really great program for defaulted borrowers to reinstate their loans. So I really understand those terms because I'm the one who kind of made sure that we were complying with the regulations.
So you were complying, and you were also in a position to pursue consumers for this debt. But then, of course, you also know where the options that are available to consumers, because if those were brought forth to you, then you would have to comply with those guidelines. And now you're able, in that capacity, to provide that information to consumers and also pursue unfair debt collection practices that I don't care what anybody says. I know they go on all day, every day.
Oh, absolutely. I mean, that's the thing about student loans is you have a lot of, let's face it, debt collectors are compensated by what they collect.
Right.
That's how they get paid.
Sure.
They get a percentage of what they collect. So
not that there's anything wrong with that, right?
Of course not. There's nothing wrong with that. But you have to realize that when you're talking to a debt collector.
Right.
And so they are going to obviously push you to things that they get paid more for. And the fact of the matter is when it comes to student loans, especially if you're collecting for the federal government, they get paid more for getting you to pay a certain percentage of that loan than if you maybe utilize one of the other options that were available to you as a right.
So what happens when you begin to default? What typically happens? What's the process that goes on internally that we don't see? What is that goes on?
It does take quite a bit to default on a student loan. And so what happens is that if you stop making payments, at first the guarantee agency has to contact you. It's called default diversion. So you might start getting, phone calls saying you're behind on your student loan payments. Please start paying your lender. Or realistically, you have a servicer. That's one of the other players involved. Most of the banks that lent out the money, if you were had a FFELP loan, they call it, have servicers that are kind of keeping up with you where you're at, collecting your payments. And so you'll have default diversion come into play. And if that's not how, and they're trying to, again, inform you of all of your rights and let you know that you can get deferments, forbearances, maybe advise you of different repayment options. If you don't respond to that or don't do any deferments, forbearances, after 270 days of non-payment, so let's face it, it takes quite a bit of non-payment to default. Once you default, the lender will then file a claim with the guarantee agency, and then you're at the guarantee agency. Now you're defaulted. And from there, they'll either collect in-house, so you'll either...
So that's the trigger point where you're going to collections at that point.
Exactly.
All right.
The stuff before that is not really... it seems a little bit like collections, but you haven't defaulted yet. People are still calling you and trying to get you into payment plans or deferments or forbearances, but it's not collections per se. Once you default... That's when the hammer comes down. That's when you're going to lose your right to deferments and forbearances. That's when you're going to lose your right to the income-based repayment plan or the income contingent repayment plan, and possibly be liable for collection costs and start having negative things reported on your credit bureau and be subject to administrative wage garnishment and having your federal tax refunds offset.
Wow.
I've always said student loans are kind of a double-edged sword. On the one hand, it's amazing that you can get out. And it's an unsecured loan at really favorable rates to get the education of your choosing. And the repayment terms are amazing for an unsecured debt. As you're aware of, with all their types of debt out there, an unsecured debt to have these type of repayment terms is really astounding. But if you don't pay, the hammer comes down on you.
That's when it all changes.
Yep.
And you know, the one thing, you know, education being its own virtue is only goes so far. When you know, I've got clients who are attorneys who have $150,000 in student debts. They are paying more on their student loan debt than they're paying to live in their house or rent a home, and it is just stifling. And at some point, they need somebody like you who can step in and put in place an affordable plan. Now, when somebody defaults and it goes to that point, you know, as you say, the hammer falls, and now, you know, they're not eligible for deferments. But in fact, you can actually step into the fray and take a step back and help them get back into an affordable payment plan. Is that correct, Curtis?
Oh, absolutely. And that's one of the things that most of these collections, or I shouldn't say most, some of these collection agencies.
Yeah, we want to be careful, right?
Absolutely, absolutely. You know, and the fact is, like most, I think a lot of people do comply with the law. I know that the company that I worked for definitely did it because there's nothing wrong with that. And they kind of walk people through and tell them all their available options and let them choose which ones they want. But not, you know, as we all know, there's always that rotten apple in the barrel. And so they'll come in and just say, here's what your payment is. And you have to sign this contract, and if you don't do it by the end of the day, we're going to garnish your wages. But the fact is that under the law, a borrower is entitled to a reasonable and affordable payment based on their total financial situation. So what you do is you look at your income and your expenses and figure out what you have left to make that payment. And it's funny because I was recently talking to a collection agency for a borrower, and they had called her up and said, you have to pay $260, and she, you know, had a job where she made, you know, less than $18,000 a year. Just really, I mean, really, her budget did not allow for that. And
in other words, the payment plan had nothing whatever to do with her capacity to repay the loan. They just basically said, you got to pay this amount of money because this is the minimum, and that's it.
Exactly. They said, this is what you have to do, and they'll even say things like, this is what the government requires. And, of course, she can't afford to pay that. And if they don't pay it, they're going to garnish her wages. And, you know, and she was distraught. And so I got involved, called them up, and they'd kind of gone over a little bit of her budget, but hadn't talked about, she said, like food, or they asked about her car payment, but not how much she paid in gas. So you might have a car, but without gas, you can't really get around. And so I call them up and start saying, let's go over this. I assume you're talking about a rehabilitation payment. Yeah, that's what we're talking about. So I said, okay. I understand you didn't really go over a budget. Oh, yeah, we did. And I'm like, well, what do you got? And they're like, well, we have this, that, and other thing. They had $100 for food for a month.
Oh, my.
You can't eat at Taco Bell and live on $3 a month. And so I started going over a budget and, you know, came out. And at one point in time when I went over the budget and the payment came out to be about $50 is what the client could afford, the woman on the other end said, well, you know, you have an $18,000 debt here. I said, well, yeah, but this is a rehabilitation payment. It's based on her financial situation. And she said to me, well, that's not our policy.
Oh, wow.
And I said, but it's the law. And I think she eventually, and after citing the law to her, she said, fine, what do you want to pay? And I said, well, you know, $50 is what my client can pay. Okay. That was her response.
You know, and for my part in all of this, I know how little people understand about their own personal budgets. You know, when you talk about these expenses, when you can put these expenses forward that are legitimate, no question about it. If you've got a car, vehicle maintenance and the cost of those things, all of these things are things that people don't consider, and they walk into a payment plan that has no hope of sustainability. And therein lies the problem, because when you enter into a payment plan after having defaulted and then you default on that payment plan, boy, at that point, that's when things really get bad. So you want to be really careful that the payment plan that you enter into is one that you actually can sustain and afford.
Absolutely. I mean, that's the key. What's the point of just setting you up for failure in the future?
Absolutely.
And,
absolutely.
You know, and the key about rehabilitation of your student loans is once you've defaulted, the rehabilitation basically undoes the default, and it sends it back to the lender. And then once you're back with the lender and you're not defaulted anymore, then you can go back to one of those income-based repayments, or, you know, depending on what kind of program you're in, income contingent. So hopefully it's affordable for you, and that you'll succeed, because that's really what, I mean, That's what everybody wants.
Right. We're here talking with Curtis Zahn from Champion Law, talking about student loan debt, the unfair practices of collections, and how you can fight and know your rights. And Curtis, that is his specialty. Want to encourage everyone to go to Financial Crisis Bible. That's www.financialcrisisbible.com, and download the Financial Crisis Bible. Give you a lot of information about how to deal with student debt and all other types of debt, and also to go to the CYA21.com website, where you can get additional information, get contact information to find Curtis, and to have him take a look at your case. When we come back, we're going to talk about how you can use the practices of a collection agency against them to try to defer your payments, to lower your payments, and even in some instances bring a lawsuit against them and be able to forego the debt altogether, which I find to be incredibly interesting. So we'll take a break, and we'll be right back with Curtis Zahn from Champion Law.